All right, welcome to the Explainer. Today we're digging into the really fascinating economics of Bitcoin mining, and we're going to be using a great paper from the National University of Singapore as our guide.
So, let's kick things off with a real head-scratcher. Picture this. You are literally creating a valuable asset, one that many people think is going to be worth a fortune. Why on earth would you sell it, especially when the price is tanking? It just seems to go against all logic, but it's exactly what was happening.
Well, it turns out that question is just one piece of a much bigger puzzle. Actually, it's two big puzzles in the Bitcoin world that economists have been trying to figure out for a while. So let's unpack this.
Okay, puzzle number one. Just look at this chart. Between 2013 and 2015, you see miners' Bitcoin stash just steadily dropping. Meanwhile, the price? It's all over the map. So what gives? Why were they selling off this incredibly valuable asset almost like it was a hot potato?
And then we have puzzle number two. For years, transaction fees were just flat, super low, super predictable. And then, bam, 2017 hits and they go completely vertical. What happened? What flipped the switch and changed the network's economy overnight?
Okay, to get to the bottom of all this, we've got to put ourselves in a miner's shoes. You have to remember, they're not just hobbyists. They are running a business, a very unique business with some really specific choices to make every single day.
So, when you break it all down, a miner's business is pretty straightforward. They make money in two ways. From those brand new Bitcoins they get for solving a block, that's the block reward, and from the fees people pay to send transactions. But here's the kicker. The one thing they have total control over is when to cash out. When do they sell the Bitcoin they've earned? That is the million-dollar question. Now, these block rewards, they're a huge deal. It's how new Bitcoin enters the world. It's the miner's main paycheck. But, and this is a huge but, the system is designed so this paycheck gets cut in half every 4 years or so in an event called the halving, and eventually it's going to go to zero. Gone.
All right, so back to our first mystery. Why sell when prices are low? You'd think they'd hodl, right? Well, the economic model shows us it's way more complicated than just looking at today's price. Their decision-making is actually way more strategic. It's about playing the long game.
Okay, so the research boils it down to three key things. First, the obvious one. They've got to keep the lights on. Mining rigs and electricity bills aren't cheap. But the other two reasons, that's where things get really strategic and honestly pretty fascinating.
And this really gets to the heart of it. What this quote is saying is that the fear of a sudden catastrophic price crash is a way bigger motivator than the hope of the price going up. The paper calls this jump risk, and they estimated it could be like a 10% downward price jump in a single week. So for a miner, it makes total sense to sell now and lock in profits rather than risk waking up tomorrow to a massive loss.
Okay, so we've cracked the first case. Now for puzzle number two. Why did those fees suddenly go insane in 2017? Well, the answer comes down to one single fundamental limitation baked right into the Bitcoin network itself. And that limitation is something called block capacity. Now, the bus analogy here is perfect. Imagine the Bitcoin network is a city bus that departs exactly every 10 minutes. The thing is, this bus has a fixed number of seats. It can only carry so many passengers, or in this case, transactions, at a time. So when it gets busy, you've got a problem.
And this slide explains it all. Before 2017, demand was pretty low. The bus always had empty seats, so miners would just take pretty much any passenger who showed up to collect their main paycheck, the block reward. But then 2017 happened. Demand went through the roof. Suddenly, the bus was packed, and there was a huge line of people trying to get on. So what do you do to guarantee your spot? You start offering the driver a bigger tip, right? That's exactly what happened. Users started outbidding each other with higher fees, and that's why we saw that crazy spike.
So we've solved our two puzzles. We know why miners sell, and we know why fees spiked. But now let's connect those dots and look at what this all means for the future of Bitcoin, because this is where it gets really, really interesting.
So if you take away anything from this, it should be these key points. First, miner behavior is way more rational than it looks on the surface. Selling isn't about panic, it's about managing risk. Second, those transaction fees aren't random. They are a direct measure of how congested the network is. It's pure supply and demand for that limited space on the bus. And finally, those two income streams miners rely on, well, they're headed for a showdown.
And this timeline really lays out the future. Look at this. Back in the 2010s, it was almost all block rewards. But as we head into the future, those rewards get smaller and smaller.
The system is intentionally weaning miners off this subsidy, and eventually, after 2140, it's gone. Both. The only money to be made will be from transaction fees.
And that leaves us with this huge, lingering question. The entire security of the Bitcoin network, everything that makes it work, depends on paying miners to protect it. In the long run, that payment will only come from fees. So will that be enough? Will user fees alone be a big enough incentive to secure what could be a multi-trillion-dollar global network? Honestly, that's one of the biggest unanswered questions in all of Bitcoin, and its future might just depend on it.